Morning, Will.
Good morning, brother Rich. How you doing?
I'm doing fantastic, man. Uh, got a damn fine show for you today, as the
Well,
Hodge twins would say.
we'll see what we can do.
I was
See,
looking through. I am going to learn a lot on this show from you because I looked at most of it. I'm like, yeah, I don't, I don't know what's going on here.
well, we will attempt to educate our favorite cymbal banging monkey. And
Beep.
yep, there you go. Yep. Admitting the problem is the first step, brother. Um,
Yep.
so yeah, we're gonna do a lot of review today, but we haven't gone over a lot of this material in months, if not over a year. And so this is the start of a series we're doing that we entitled MELTUP, which is there's a theory out there that this is where we're headed is a melt up.
Well,
Um,
if you go back and watch, I think it's important for people to get the series to watch last week. I mean, obviously, you'll take a lot of value out of today, but if you want to contextualize everything that's going on, you got to look at the show Will entitled "The Wall" from last week, wasn't it?
mhm.
Last
And I'm glad you mentioned that because at some point in the show, I was going to wait for an opportune time to bring it up. We talked about that, and I was watching a. I try to watch some stuff that is contrary to what I think, because that's how you learn, right? And there's a theory out there that debt wall that we talked about, the including this year's deficit, the $9 trillion that has to be financed, isn't going to be as bad as some people are saying, because some of that is going to be money markets, money market funds and mutual funds rolling over bonds they already have. So if
week.
you got, say, a 60-40 mutual fund that holds 40% in bonds, some of that's just a rollover. And that's true. I think there's some substance to that. However, I think they're also whistling past the graveyard with some of that because it is so much more than it has been. If we were talking, if we were talking about financing 20% more than we have over the past number of years, then I'd be like, okay, yeah, they have a point. But it's something like three times what we
Right.
normally do. So I think there'd be some truth to that theory, but I still think the debt wall theory holds. Um, but I want to throw that out for the other side of the argument for everybody too.
Appreciate that, Will. Speaking of Wills, Will Parker
Mm,
is on, our good friend out
awesome.
there in Montana, coin number 800, headed to Andrews to ride. Hope you guys have a good and safe time. Please
Yes.
give Mr. Bronco a big hug. Michael Gentili is on. This is good morning.
Morning,
And
sir.
please like and hit that share button. And we will go ahead and kick today's show off with the Fear and Greed Index.
Yes, our standard start here. It has popped up quite a bit, as we can see there, the chart below. It bottomed out in April with the tariff announcement, or shortly thereafter, and it's
Mhm.
been moving its way back up. I see Mark's here. Good morning, sir, from Canada. Um, and it's going to go up some more today. Over the weekend, the Trump team met with the Chinese officials, and they're making significant progress. So I think last I looked, Nasdaq futures were up almost 4% for the morning.
Yeah, I saw this morning, and I will have talk about it in the next slide, that an agreement has been reached for a 90-day moratorium, moving the tariff down. We'll talk about that in the next slide. But
Okay, awesome. So the point is, I would expect to see when the Brits sign theirs and all the details were released versus just a framework. I would expect that to set the tone for the remaining the negotiations. Um, on your next slide, you get into the theory out there that Trump's trying to build a wall around China. I don't want to steal your thunder. Oh, you're muted, brother.
I said no, no, no.
Okay.
I'm not going that deep into it. But yeah,
So I don't know the details of it. I was working over the weekend, so I haven't had a chance to really look at the British deal too much. But there's a theory out there that, okay, yeah, we'll do this with the tariffs, and we'll do that with the tariffs. And by the way, Germany's already saying they want to go to a 0-0, no tariffs either way, which isn't the whole story with Germany, because they also add a value added tax
mhm,
to, say, American trucks that they
yeah,
don't add to their own. So then they subsidize through there. So there's more to it than just the tariffs. But back to my original point before my squirrel moment there, the uh, the theory is that some of these trade deals are also going to include, okay, we'll do a tariff of this much with country X, and have this deal. But part of the deal is country X will also tariff China, so that we start to build a Western wall or an alliance of tariffs around China to control them that way.
Man, we love our International American Warrior Society members. And if you're just joining Will and I, this is the American Warrior Show's Monday morning edition, where we normally talk finance and world affairs and geopolitics. It's from two guys that have no business talking about that whatsoever.
Yep. I
However,
resemble that remark. Yes.
but we got Mark over in Australia is on.
Mhm.
Mark Hamilton is on. Guy from the Philippines will probably be on in a moment. And we love our international members. However, when we ship an American Warrior Society challenge coin, if you want to find out what that is, click the link in today's show notes. It costs like $30. When I was shipping my books overseas, people bought my book on violence and varietals. They might buy the book for $19.95, but then it's going to cost me $30 to ship it to them. So I was literally losing my ass sending it overseas because of the value added tax and things of this nature. So if that's a workaround for these countries, man, the VAT tax is absolutely BS. So we need to do something about that.
Yep. And the way that works, I'm going to say in Europe in general, because I'm not sure if it's country by country with this. So this is more of a general comment. They'll put a 20% value added tax, and the value added tax is very common in Europe. And that is each stage of improving a product. So you go from a raw material into a part into a full vehicle. For instance, each step can add a value added tax, which is 20% in Europe. And so what they'll do is they have this value added tax, and the value added tax is on each vehicle, no matter where it's manufactured, but they will take the value added tax and use that to subsidize the car manufacturers or manufacturers, period, in Europe. So they're getting a workaround. So the consumer is subsidizing. If they buy the Ford, they're actually subsidizing their domestic, say in Germany, domestic BMW manufacturing.
Yeah.
And it's, yeah.
It's no. Mark says they call it GST in Australia, goods and service tax. Now, back in 2017, when I went to the UK, at the end of your time there, you could take all your receipts, put them in this thing, and you get all those VAT taxes back. So we got hundreds of dollars back. So when I went this last time, last year, whenever it was, I'm thinking, hey, don't worry about it. Just keep your receipts. We're going to get all of it back. Nope. They ended that like 3 months before we got there. So it's
and this is, yeah. And it's, I mean, 20% is no joke. I mean, I complain about 6% here in Wisconsin sales tax. Yeah. So it's and people don't see it over there because they don't put the taxes separately on the receipt in Europe, is my understanding. So if I'm wrong on that, I stand by to be correct, but I've been in Europe in a long time.
I'm pretty sure the UK had it on the bill. You can see what it was. Yeah.
All right.
Yeah. Could be.
So yeah, it's one of those things that runs around that people talk about. Well, I don't see why, like you see a price for something for $5 in America, you get it to the register, it's more than that. Apparently in Europe, it's already in there. I don't know.
My buddy had a good point. He says, I think they should not allow your taxes to come out of your paycheck. And at the end of the year, you have to go and write that one giant check and then go to the voting booth right after that. I'm like, yes.
Yes, it wouldn't work because people would spend it all. And B, there would be a revolt. Therefore, it's never going to happen.
No, it won't happen.
Yeah.
Who we got on this morning?
Oh, let's see who we got. We've got we've got Ted Leonard on from the great state of Mississippi, coin number 1461. Mark is on from Australia. Tony is on, another international listener from South Carolina. We got Donald's on from occupied Virginia. Will Rhodes getting ready to go riding. Awesome. John Shriver. Yes. John Shriver. Yeah. Yes, we do. Yes. All in favor of lower dues to rich, say aye. John Shriver from Yukon, Oklahoma, the driver of the very pretty Mustang, is here. Mark, I think I misspoke, said you were from a different Mark. Sorry. This is Mark Hamilton from Canada, 13% value added tax up there in Canada. And Mark, you were talking about the luxury car tax there in Australia. We tried that here in America with the luxury tax, and it decimated the high-end boat industry here.
Mm.
That was, gosh, 80s, 90s, early
Yeah, I remember
90s.
that because was it Sunray, or there was some giant boat manufacturer that was built in Knoxville, and the city was just
Hmm.
so excited, and it was going to bring all this revenue. They put in the luxury tax, and it went.
Boom.
Yeah,
Yep. Yep. And then
crazy.
everybody just started buying their boats through offshore LLCs.
Yeah, Derek is on also. Says good morning from North Carolina. Um,
Awesome.
so I think you, to your point though, that the market is going to have a really good day today
Yeah.
based on the tariff deal with
Yeah.
China.
And basically, it's the bounce back after the slump after the tariffs, which
Yeah.
anybody who watches the market, I think it's reasonable to say we knew this was coming. We weren't going to stick around with 145% tariffs on Chinese goods. It's going to stick around long enough to cause enough pain on both sides to make everybody come to the table. I just saw a blurb on CNN Finance this morning, CNN Business, whatever they call their channel, saying that there's currently 0 ships en route to America from China. We haven't seen this since the pandemic. So there's going to be a burp in here. Okay. And, I try to read through both sides of stuff. So I read CNN Business and I read Fox Business and CNN Business. I mean, I believe 2/3 of the articles on their front page of their website were all, one of them was drill, baby, drill. Well, where is it? Well, it's like, dude, it's been 100 days. I mean, you don't just throw it. This isn't Landman on Paramount. Okay. You don't just throw a rig up in 4 hours. Okay. So and I'm sure I didn't go to Fox Business this morning, but I'm sure they would be all gushing all over, this deal and, so on and so forth. So the truth is somewhere in the middle, guys.
Yeah. So let's get into just before we
let's see what you
get
got
into Will's show. I just want to let's don't take our eye off the ball. We got the first American-born, Chicago-born, if you want to get technical, Pope Leo, will further the leftist slide of the modern Vatican and will be at odds with the growing American Catholic right. Catholicism has seen a resurgence here, and for a lot of maybe it was me and TC Fuller were talking about this. All the senior officers at my last command for 6 years were Catholic. I mean, all of them except for this one lone Protestant guy here. And TC said the same thing for the FBI. So
it was kind of like the Troubles.
Exactly. I'm surrounded. I'm being pushed into the sea.
Yeah.
But yeah, I mean, so this is like you and I were talking in the green room before we came on this morning. The Pope Francis had appointed like 80% of the cardinals that actually voted in this last conclave to get a guy that was going to continue his agenda. So here we have Chicago-born Pope, and he is just going to continue to alienate the right of the Catholic. I mean, Vice President J.D. Vance is he became a Catholic, and he's one of these right Catholics, and he's not very happy with this guy, and I don't think this guy's very happy with the Trump administration. So we'll see where that goes.
Yep.
An interim deal, like we talked, Will, between the U.S. and China, will roll back the tariffs from 145% to 30%. This is only a 90-day deal, so but I think the market is going to soar today. So good luck to everybody out there that's playing in that market. This is a weird one, man. Trump plans to accept the luxury 747 from Qatar. Have you seen this?
I did. I read just a very little bit on it yesterday. And of course the left is making a big deal out of this. The problem is Boeing is so far behind on production. I think they were looking at 2030 before they would get the replacement Air Force One and have it retrofitted. So this is going to move that timeline up significantly. And they're saying, the Russians could have listening devices in there or whatever. It's because they're going to bring it over and 2 days later put it into service as Air Force One with President of the United States just stenciled on the side of it. Come on, give me a break. It's going to be gone. It's going to be gone through, ripped out. It's going to be torn down to the studs, so to speak, and then built back out by American contractors. So I haven't dug into it deeply, so I stand by to have my opinion changed, but big deal.
Yeah, I guess I hear you. And of course, to me, it's a Trojan horse, and it probably is. It's just like they had to take the resolution desk out. Everybody's like, they're cleaning it up. They're restoring it. No, they weren't. They were checking it for bugs.
Yeah.
You know that, right?
I wasn't aware of this. No.
Yeah, they took the resolution desk out of the Oval Office when Trump came in to make sure it wasn't bugged, and they're gonna tear it, like you said, tear it down to the freaking studs and then rebuild the damn thing.
Yeah.
Same thing with this. And when you look at the cost, I'm just spitballing here.
Mm-hmm.
Millions and millions and millions of dollars are going to be spent making sure this thing is not a Trojan horse. And it's like, okay, guys, is this the juice going to be worth the squeeze here?
Yeah. Well, the big problem is the timeline. Air Force One's been, from my understanding, I don't follow this closely, been long overdue for a replacement aircraft. So this is a way to accelerate that timeline, because the one article I did see was talking that the airplane wouldn't be delivered from Boeing until 2029, and then a year to retrofit it.
Wow.
So this moves that timeline up by a number of years here, probably 4 years.
What does it tell you about American manufacturing if we went to war?
Yeah, exactly. Great point. Well, and some of that too is, I take your point and I agree with it. But by the same token, if we really went to war, I would guess a lot of things holding up Boeing and other manufacturing would go away real fast in a no kidding war. Suddenly, you wouldn't have to have an environmental services or environmental impact survey done that takes 4 years and 10,000 lawyers.
You know what? You would hope, but I have little faith in that. But that's just me. I'm jaded.
I'm right there with you, brother.
Tony says Joe Biden named new pope after 3 a.m. influx of new votes.
Yes. And there was the meme running around, the tariffs are working so well, even the new pope is from America.
Yeah, I love that.
Yeah. Yeah. So it's love all. I've got Catholic family members, love you all, but it's it was a good meme. What can I say?
Yeah. I don't know this gentleman's name here, so I'm going to butcher it. Ross Baraka, the Democratic mayor of Newark, New Jersey, who happens to be running for governor, was arrested on Friday while storming an ICE detention facility with various members of Congress. This is one of those, man, that, I mean, what's going on here? I want a commission. I want to see people hunted down and go to jail. If we're storming detention facilities now.
Yeah. Yeah. All this is going to come to head. This is all part of the fourth turning, right? We're going to decide where things are going to go, and it's going to be messy as a country we decide which direction to go.
Yeah. So India and Pakistan had a 4-day war that could have went hot. They've got a ceasefire going right now. Will it hold? I don't know. But that thing is definitely something to watch. And for one reason why, one of the many reasons why, obviously they're both nuclear armed countries. They both hate each other. The other thing is, this is the first time a lot of these weapon systems have fought each other. Chinese made weapons versus NATO made weapons. So it's going to be interesting to see. Obviously there's a lot of, it depends on who's using them, things of that nature, but it's going to be interesting to see, wouldn't you say?
Yeah, little testing and development for the rest of the world, the manufacturers, if you will, of these weapons. And I really don't know enough about. Actually, I know very little about their centuries-long conflict between those two countries. But one thing from a stock guy's perspective to keep an eye on is India has the largest working age population of people in the world, so they're the next China over the longer term. A hot war that changes that or affects that will affect their ability to manufacture things for the world, because that's where things are moving.
Yeah. So on that topic, when I think of India, and geographically, it's almost an island in the sense that it's got the Himalayas to the north. And if you look, India was its own island at one point, and then it slammed into that landmass and arose the Himalayas. I say all that because there's 1.2 billion people in India, 1.4,
something like that. Yeah,
it's an insane number.
Every time I start counting, the number changes by the time I get done.
Oh well. I know you're over there counting Indians. That's
yeah. It's one of my hobbies.
It's just. Here's my point of saying that: if there was a nuclear exchange and you have one. Let's say you go from 1.2 to 1.4 billion people to an irradiated 800 million people, and they're trapped in by the Himalaya. It's a potential mess if those guys start dropping nukes on each other.
Yes. Yep. Absolutely. Yeah, and those are the wild cards, right? The black swan events that nobody can predict. Nobody can be like, well, I'm going to go short the Shanghai, no, not Shanghai, Shenzhen, no. I'm forgetting the name of their stock market. I mean, I'm going to go short the Indian stock market because I think this is going to happen. Well, that's a fool's errand. Okay.
Yeah.
So those are the things that you really can't protect yourself from unless you own your favorite commodity,
Gold.
gold. Yes, which is why we advocate always holding some gold. So it's not going to do you any favors today, but that's one day.
That's right.
So, um,
I mean, like I said, 200% returns compared to when I was buying it pre-pandemic.
Yep, it has been on a run.
Yeah.
And if things start to stabilize, a lot of that run will get pulled back, I think. That's
But
a
again,
big if.
this is an unrealized run because I haven't cashed it in.
Yeah.
But I do have friends that are like, hey, man, remember when you were telling me to buy all that gold? Well, dude, I could sell out now. And I'm like, okay,
Yeah.
good luck with that.
Yep. Well, and there's many ways to play that. I play that both physical and paper. I've got the physical gold I never get rid of, and I've got the paper gold that I traded out of. I got 100% out about 10 days ago now.
Bingo.
So, yeah, looking smart right now. We'll see if I look smart in another week. A lot of times it doesn't hold.
Bruce is on from Michigan. He is coin number 481. Michael says India and Pakistan have week-long wars on a regular basis, like the World Cup cricket. Yeah, he's absolutely right. However, this was the largest one, I guess, since 1999. I'm being told. I don't know. Okay. I wasn't on the ground. But that's the black swan thing of this, isn't it, Will? We get used to, it's like a football team. I put them to sleep with the run. I'm just running the ball, running the ball. And then here comes the freaking pass. Nobody saw it coming.
Yeah.
This is I don't think we can say, not that Michael's implying that it's a nothing burger, but it's a nothing burger till it is a nuclear exchange.
It is. Yeah. And it's, will who is the president of the United States affect this? I think so. You got stronger leader. I saw a thing and it was a meme-ish thing. Some left-wing commentator said, India and Pakistan are doing this and Trump's doing nothing and got caught, unaware and blah, blah, blah. And like 4 hours, the Trump White House came out and said, yeah, we've brokered a ceasefire deal, so I don't know. I mean, would it have been different under Biden? I mean, I'm sure they would have tried, probably, maybe succeeded. I don't know. But the point is, who is the president of the United States matters in these other conflicts many times. It's not going to solve it, but it will put a Band-Aid on it for a while.
100%. All right. So for world stuff, let's get into today's show, my brother. The MELTUP series, episode 1.
So this is part 1 of 37. No, I'm kidding. Probably about 4 parts. So there's a theory, a train of thought out there that we are headed toward a MELTUP in all assets because the value of the dollar is going to plummet. Okay, we're going to get into that. I think there's some credence to it that it could happen. We already saw a little bit of it with all the money printing during COVID, and then of course we had the comeback down in 2023 when the market was down 30%. It's come back up. So I think this is a
case. Could we make a case for gold's run up like that the dollar is devaluing?
Yes.
Okay.
Now, oddly, I should say traditionally, yes, you can make that case. Although oddly, during much of the gold's run up in the last couple of years, the dollar was also strengthening. Now the dollar was mainly strengthening; these other currencies were weakening even more.
Exactly.
Yeah, so it's all relative. And gold is a funny one because it really trades more like a currency than a metal. Silver, for instance, trades completely different than gold, even though they're both metals and they're both denominated in dollars in our case, because silver is used in so many industrial applications. So when the economy slows, typically silver goes down. So, and typically if the economy slows, they print a bunch of money that devalues the dollar, and you would think silver would go up with gold, but usually it doesn't because the vast majority of silver is used industrially. So it's the same but different. Over time, it tracks the same way, not so much quarter to quarter, even year to year. So All right, so we're gonna build on a lot of stuff we've talked about in the past, and today we're gonna review a lot of that. For those of you who do not go back and diligently study our old shows, shame on you. So we're gonna go back and look back. We're gonna cover about 100 years worth of Federal Reserve history on the next slide. It'll only take about 115 years to do that. But I would do want to get into how the things that the Federal Reserve does, it shapes our daily lives whether we realize it or not. We react to these incentives because we're rewarded if we react to them. You know, something as simple as buying a home. My oldest is getting married, and he and his fiance just bought their first home. Okay, and they're being rewarded for that. I mean, they get certain tax write-offs, right? And then they're building equity as well. And over time, it'll be an appreciating asset. We get rewarded for these things. Hence, the way the tax code is written is to incentivize people to do these things. All right. So today we're going to go over the origin of the Fed with a review of how it's morphed, because what it is today isn't how it started at all. And they're reacting to their own incentives as well. So not a huge fan of Warren Buffett for a lot of reasons. However, his partner, who has now passed away, Charlie Munger, famously said, "If you show me the incentives, I will tell you what the outcomes will be."
Amen. That's exactly right.
Okay, so 1913, Federal Reserve Act was passed, and a whole lot of things led up to that. But we got the Federal Reserve in 1913 by hook or by crook. That's what happened. Okay, 1917, they really start kicking in. Okay. Also, it'd be the start of World War One. Just a trivia point, but it did cause a lot of money printing because we had to fund a lot of doughboys going overseas, right?
Mm-hmm.
So printed a lot of money. We get the Roaring Twenties, and this is something that I think gets glossed over. Is the Roaring Twenties was basically an inflationary period because of all the money printing that happened during World War One.
Oh, yeah.
And again, history rhymes, right? So we're seeing that now, and you can you can draw a parallel to that. COVID wasn't a war, but it was a lot of money printing in response to an external event, right?
Mm-hmm.
All right. So now let's dig a little bit into the response to the Great Depression. So the crash happens October of 29. Initially, the Federal Reserve raises interest rates. And up until recently, I thought that was the dumbest thing ever. Right. And based on our current thinking, when some sort of crisis happens or a recession happens, they lower interest rates to spur economic activity, right?
Right.
Well, what we don't think about now is they had different incentives then, going back to that little sub theme we're going to hit today. There were two forms of legal tender back then. There was the US dollar, which was still very new, and there was gold. Gold was still legal tender. So there was a competition going on between this new Federal Reserve note and gold. And people didn't trust the Federal Reserve note yet because it was only 13 years old.
Mm-hmm.
Sorry, bad math, 27 years old, 17 years old. Gosh. Illinois public school. Sorry, guys. Yeah, exactly. I just keep working with it. So think of the people, say, who were 35, 40 years old when the Great Depression hit. They remembered pre-Federal Reserve note, the booms and busts and crashes, which were very common. So they're not really trusting this newfangled paper thing that everybody has to use now by law. And back then, you could take your Federal Reserve notes to a bank and say, "I want my gold." And it was gold. Gold was valued at, it was a set $20 an ounce. So if you had $100 in these Federal Reserve notes, you could take it down and get your 5 ounces of gold. Boom, done.
Good old days, buddy.
Yeah, no doubt, right? But this caused a problem because suddenly there were these runs on the banks everywhere. So how do you get people to keep their money in the bank? You raise interest rates.
Mm-hmm.
Because I can get my gold, or I can leave the money in my bank account and I'm making up the number, make 5% interest.
Mm-hmm.
Okay. Well, if prices are going down during a depression, prices are going down by definition in a depression. Well, I can make even 1% over there. Well, that's increasing my purchasing power every year. Well, that stabilizes the system, right? But it also
Yeah.
is what that, and also banks were pulling back on their risk taking. In other words, they weren't writing loans.
Hmm.
So that also caused it because the banks didn't want to write loans because they didn't know if people were going to come in and demand their money. So those things work together to cause a recession, a bad one, to turn into the Great Depression.
There's a great story of Huey Long who was the governor of Louisiana, who would, hey, governor, there's going to be a run on the bank tomorrow. The whole town's talking about it. They would sneak him in the back door. He would set up a table in the lobby, and he would write out a check for $1 million or whatever. And he would sit there and then go ahead, open the door. And like, you see that the bank says the first one here gets to cash their check first. Here's mine. Now I'll keep my money in the bank if you keep your money in the bank. Or if you say no, I'm going to cash this and nobody's going to get anything.
Mm-hmm.
A very like King Solomon way of doing business.
Mm-hmm.
And he was able to, a few of those get around. The word gets out in the paper, and you never knew if the governor was going to be sitting in the bank lobby when you got there in the morning.
Yep.
And he was able to stop this. And I remember my grandfather, we had a bank failure in Knoxville, Tennessee back in the early 80s. And I remember him sitting there with tears streaming down his face. He's like, I'm not going to do it because I remember during the Depression, this is what got us there. But man, I hope I don't lose everything.
Mm-hmm.
And then he was terrified, but he had I don't know, the courage or what do you want to call it, Will, to be like, I just got to trust. But he had a hard time trusting the government. But he's like,
Mm-hmm.
I don't know.
Well, and it did take courage to do that. I would call that courage.
Yeah.
I would argue that if something like that happens today, it would require less courage from us because Silicon Valley Bank, they set the precedent, right?
Yeah,
Not only will they cover up to $250,000 as per the agreement per depositor, they covered everything.
True.
So that die has been cast. That $250,000 thing, it really doesn't apply anymore if the bank is big enough.
And I think back in the 80s, it was maybe $50,000. It wasn't 250.
100,000 sticks in my head, but I could be wrong.
Yeah.
I think it went to 250 somewhere during the COVID area, I believe. So during the Great Depression, you've got the banks are incentivized to not give out loans because they're scared of a run on their bank.
Mm-hmm.
The Federal Reserve is incentivized to keep their new baby, the Federal Reserve note, viable, so they raise interest rates. So you have banks decreasing the amount of lending they're doing and interest rates going up at the same time. We get the Great Depression. Okay. Now, and then people are also incentivized because prices keep going down. So why would I buy the new washing machine this month if I can stick some baling wire and bubble gum on this one and get it to last a few more months? It'll be that much cheaper. Well, that starts happening too. Okay. Also, banks could do something back then. As an aside, they could call any loan on a 30-day notice. And this is where the whole pay your house off thing starts to come from, because people lost their homes, even those who still had jobs were losing their homes, even though they could service that debt because the bank could call the loan. Well, if other banks are pulling back and not lending, you can't get another loan. You lost your house.
Mm-hmm.
So that's where the pay your house off thing came from. It wasn't always just, hey, you can save this much money on interest. And that's a whole nother discussion about strategies within that. And you and I differ on that. And that's great. But that's where that started coming from. So again, everybody's reacting to their incentives, right? Our grandparents paid their houses off in reaction to a totally different incentive than what we think of today, which, by the way, now is illegal. If you're servicing the note, the bank can't call the loan. They can't foreclose.
No.
Okay. And then overall, the Fed goes fairly quiet from 1944 through about 1972-ish. Okay. And during that time, everything just kind of chugs along. We had some pretty bad inflation in the 1950s. But overall, pretty quiet. There wasn't a Great Depression. There wasn't the other stuff we're going to talk about in the 70s right now, which then we get to Arthur Burns, right? Inflation started taking off in the late 60s. very expensive and ultimately unpopular war in Vietnam, and a lot of social spending with LBJ's Great Society programs, right? So spending takes off. The world figures out we're spending more dollars than we have gold to back it up with in Fort Knox. In fact, the French are the first to figure it out. And at that point, regular people could no longer take their currency to a bank or anywhere and get gold for that. That had gone away in 1933. But other central banks could do that. And the French were the first ones to send a couple of ships full of palletized $100 bills over and say, we'll take our gold. Thank you very much. Well, others started figuring this out. August 15th, 1971, Nixon closes the gold window.
It
And
now
that could
rides on the full faith and credit of the United States government, not gold
exactly
or
right.
anything else.
Exactly right. And as an aside on that, a young Ray Dalio, a famous hedge fund guy now, who's I think probably in his 80s by now,
Mhm.
he was a wet behind the ears runner on the New York Stock Exchange in 1971, and he watched Nixon's address to the world Sunday evening, closing the gold window, and he expected pandemonium the next day at work, and it was just the opposite. It was euphoria.
Really?
It was euphoria because now the federal government is unlimited in what they can print, right?
Mhm.
Well, they were unlimited in 2020, and look what happened to the stock market for 2 years,
Exactly.
right? So,
Mhm.
again, different incentives. We look at that as holders of these things, holders of these currency notes, and go, oh my gosh, this thing just got devalued. The stock market looks at it and says asset prices are going up,
Mhm.
right?
I've talked about this before. It reminds me of when they decided they lifted the ban. I think Don't Ask, Don't Tell came in, right? Don't Ask, Don't Tell. Because before
Yep.
that, the enlistment documents asked you if you were, are you now, or have you ever engaged in homosexual acts? Do you intend
hmm
to engage in them in the military? And if the answer was yes, you were permanently disqualified from military service. Well,
Okay.
when Clinton was in office, he came in with a strategy of don't ask, don't tell. We don't ask you in the enlistment document. And one of the career recruiters at the time just kind of jumped out of a seat at the conference and was like, hell yeah. I'm like, what are you excited about? He's like, that you just open up a whole nother market.
hmm Yep.
Now I can recruit them.
Different
But I think it's
incentives,
that
right?
same kind of euphoria.
Yeah, absolutely. And this is what is very difficult for all of us at some point, some level at different times to understand about why people react to things. Um, you know, look at what CEOs and boards of directors of publicly held companies do today to jack up stock prices, right?
Mhm.
They do stock buybacks, which is not new since the
The
90s.
airlines are the worst at this.
Mm-hmm.
Your
Yes, they are.
industry is
Yep.
the worst.
Yep.
But what
And
does that do to your retirement plan? Is that a good thing for Will individually?
it doesn't really matter too much.
Okay.
Yeah, doesn't matter too much.
Okay.
The so they do this to jack up the stock price. Well, why
Mhm.
do they care? Well, they care because a lot of their compensation comes through stock options.
Mhm.
Well, why is that? That wasn't always the case. Is because in the 90s there was a big uproar about what CEOs were being paid versus the average worker. And the CEOs went, fine, I'll take a pay cut, give it to me in stock options.
Yeah.
And now they're incentivized to get the stock price up quarter by quarter, no matter what it does to the underlying business. So you file that
I've
under,
read
be
that.
careful what you ask for.
Well, you could always say, well, they have a fiduciary responsibility to the
hmm
shareholder, blah blah blah.
hmm
However, as I understand it, that wasn't always the case. You you
Yes.
you you had a responsibility, true, but at
hmm
the same time, you couldn't do it at the expense of the U.S. economy, et cetera.
It was, and here's one I just learned a few weeks ago. It was the Dodge brothers that did that, and the
Mm.
Dodge, as in
Uh,
Dodge Motors, Dodge, Ram, Charger, Demon in your case, right?
yes. Yeah.
They were, as I understand it, major shareholders in Ford Motor Company, and Henry Ford kept doing things like paying his workers more, and it was hurting the company. And the Dodge brothers sued him and won.
Mm.
I'm very new at that knowledge, so I stand by to be corrected on that. But that's my understanding. But either way, the end result is the same. There is
Mhm.
a fiduciary responsibility now, and I'll tell you what, as a shareholder, yeah, pay your workers more, whatever. But if it starts to significantly hurt the business, A, I'll sell the stock off, and B, if there's a class action lawsuit, I'll put my name on it.
Yeah, absolutely. Laughing at my rage, Nuke has a question here. How does your current opinions on the U.S. economy affect those in other countries, or is this specifically a U.S. based podcast?
Hmm.
You wanna answer that one?
Okay, so can you bring the comment back up, please?
Of course.
Thank you. Um, how do our current opinions on the U.S. economy affect those in other countries? So let's break that part down first. So if let's break that out. And if I don't touch on something you're looking at there, let us know. So you've got the tariffs. Fairly obvious how that affects other countries. But I think the bigger picture is I think the tariffs overall are going to be. It's easy to say from this side, and I don't mean any disrespect to anybody who's overseas, but it's kind of a flash in the pan, right? In the big sequence of time, right? This is a negotiating tactic as we're seeing play out specifically with China here, right? So will it affect these other countries? Yes. I think Trump has an agenda for the American side of that. I don't really know. I'm not knowledgeable enough to know exactly how it's going to affect any given country. Obviously, it will be negative, right? But this is also the opening salvo in trade negotiations to try and level the playing field as we see it, as I see it from America's standpoint, right? So I don't think I have a great answer for that. You got anything there, brother?
I mean, there's a push and pull on this thing, but I think
Mm-hmm.
we are as Americans, we're looking at it through an American lens.
Sure.
But you can't take out what the impact the U.S. economy has on the world. So
Correct.
it's a
Yeah.
simple way of looking at it for
Yeah.
me.
So I hope that helped answer that. And to your point, as far as this in a just looking at it from the American standpoint, um, I guess I'll for me I'll say I have a hard time looking at it from any other side because this is where I live, this is where I was raised. So, and I will admit I probably have some biases there that I don't even realize I have. So if you are overseas, very interested to hear your perception of these things. So that'll help all of us understand it better too.
Yeah. Dr. Furler is on. Coin number
Awesome.
1620. Back from the gym. Everything hurts, but it still functions. God bless
Awesome.
you, sir.
Awesome. So back August 15th, 1971, they closed the gold window. We get euphoria in the stock market. Stock market starts taking off. And we had some inflation running up from, say, it started in the mid 60s with all the spending on the Vietnam War and the Great Society programs. Started having some inflation. It got up to about, I'm going to use very general numbers for this, guys, got up to about 4% inflation. Let's think about this, though. The World War II generation, they lived through some pretty significant um, inflation in the 50s. And most of them were also were born very young, but they were alive for the Great Depression. Okay. And something like the Great Depression happens in your early years, it's going to affect how you see things your entire life, of course. So they don't have a lot of faith yet overall in this whole dollar thing, right? And then inflation starts to take off again, late 60s, early 70s. And the fear then and what happened then and the fear now, and you hear Jerome Powell, the current chairman of the Fed, talk about it a lot, is entrenched inflation.
Hmm.
And that is the idea of inflation or deflation, whatever it might be, gets entrenched in the psyche of the people.
This is the same Jerome Powell that told us it was transitory, by the way.
Yes, absolutely. Which was a talking point. He was trying to calm markets, and now of course he looks stupid for doing that, as anybody who lies about something should look stupid about something.
Amen.
So this is and we're starting to have this entrenched problem now. University of Michigan does a number of surveys, but they did their most recent one here on people's inflation expectations going forward. And over the next 10 years, they expect inflation. This is the people they survey. They expect these people expect inflation to run between 3 and 4% for the next 10 years. Now you can say, they just call somebody or stop somebody on the street or however they do their survey. Doesn't mean these people understand monetary policy and look at, what's going on with quantitative tightening. Have they even heard of quantitative tightening? Doesn't matter.
Right.
because it's what they feel, and they're going to react off those feelings, and their behavior is going to be based on those feelings. This is dangerous.
Yeah.
Okay. So this is what was happening in the late 60s, early 70s. Unpopular, expensive war, and a ton of social spending under a fairly unpopular president. Sound at all familiar?
Yes.
Okay.
Sadly, yes.
Yeah. So Nixon, he wants to get reelected in 74, 72. So he calls Arthur Burns to the White House and says, come on over. And he puts the screws to him and tells him he needed to lower rates. I want to get reelected. Inflation is coming down. It was coming down. I want you to lower rates because we're starting to head towards a recession here, and I want to get reelected.
Mm-hmm.
Burns initially resists, but then capitulates and lowers interest rates. Well, inflation was entrenched in people's mindset at that time, much like it is now.
Mm-hmm.
And then they go, well, hold on. Inflation's coming down, but now interest rates are coming down. Inflation could come back. That's scary. I want to go out and buy all my stuff now. And that's exactly what they did. And then that caused inflation to go back up and peak at whatever it was, 15, 16%. All the numbers jumble for me after a while. Okay. So then we get Paul Volcker. And now this, I think Volcker, while he did the right thing, it's also a very dangerous precedent to set because he, as the chairman of the Fed, raised interest rates dramatically. And this is where we get the real world example of if you want to get rid of inflation, you have to raise interest rates above the rate of inflation. That sucks money out of the system. It slows down lending because fewer people can afford things. It drives prices down. Okay. Here's where we get into the dangerous precedent part. You've got the voting members of the Federal Open Market Committee, the Federal Reserve, who will vote on what they think should be done with interest rates. And they literally go around the table. And, Rich, yes, no. What do you want to do? Blah, blah, blah. There were times under Volcker's leadership at the Fed when all 12 members voted to cut rates, and Volcker would go out and raise rates. Let's think about that. That's a lot of power. You ever voted for a chairman of the Fed? Hey, you're muted there, brother.
I said, no, I haven't.
No. And I bet neither has Tony or John or any other name I can come up with here, right?
Right.
Because we don't.
Right.
So this is an unelected official with this kind of power, answerable essentially to no one. Yes, they can be impeached, but man, that would take a lot.
Yeah.
Right. And if you go back and look at the historical record, I don't know of a Federal Reserve chairman that was ever impeached. And if Volcker wasn't, after the whole market said, 12-0 to drop rates, and he went out and raised them and nothing happened, you're going to have a pretty hard time, making that one fly, I think.
Yeah.
All right. Now, of course, that doesn't really matter when you're out talking to voters ultimately, I think it's the president who puts the Federal Reserve chairman up for impeachment should that happen. But that's going to take a lot, right? Point being, Volcker keeps raising rates, slowing the economy. It culminates in a double dip recession, 80 and 82. Okay. And history rhymes, right? Mm-hmm. Reagan famously called Volcker to the White House sometime in 81 or early 82 and said, I need you to drop rates. Midterms are coming up.
What did Volcker say?
Volcker said, I got a finger for you. It's right in there somewhere.
Yeah.
Okay. And walked out. And he didn't capitulate. Okay. So this historical context matters because Volcker is now, at the time, he was a pariah.
Yeah.
People hated Paul Volcker. Okay. He caused the recessions, nasty recessions in 80 and 82. Okay. But now looking back through the lens of history and all that, he did the right thing. Right. But that's also a little bit of resulting. It turned out good, therefore he did right. Right. Now, I agree he did the right thing, and all the numbers bear it out. Right.
Right.
But let's think about Jerome Powell or Janet Yellen when she was chair of the Fed, all these things, right? You want to be Arthur Burns 2.0 or you want to be Volcker 2.0?
I know what I want.
Yeah, yep, me too. Who cares what I'm thought of at the time? Well, how is history going? What's the legacy, right?
Right.
Okay. And Burns is, I mean, Burns' name is almost never uttered at
Did
all.
Volcker live long enough to be vindicated? I mean, in his
Yes.
lifetime.
Yes, he did.
Okay, I did not
Yep.
know that.
He and
Good.
I think he passed away not long ago in the big scheme of things. I can't remember.
Okay, good.
So yes, he was vindicated with that. Now we can also look at that and say, okay, Fed fund rates, the interest rate set by the Fed peaked in 82. It's been basically coming down ever since until very recently here with the post-COVID inflation. So now we've got the same sort of setup, right? We've got very expensive, became unpopular wars, Afghanistan, Iraq, and a ton of social spending, culminating really, I mean, starting with the housing crisis and then building and then obviously, hopefully climaxing with the COVID spending, right?
Mhm.
And now Jerome Powell's sitting on this. And if you go to the next chart or the next slide there, this one, so you had Burns who capitulated, right? And you had Volcker who stood tough, right? This time, Jerome Powell is chairman of the Fed throughout both of these eras. Okay. So old J Dog there, which when he calls me up, that's how I got him as the contact in my phone. Okay. He almost went Burns 2.0.
Oof.
And we don't talk about this too much because it's pre-COVID and it's kind of gone away. But at the time, it was a big deal. Okay. If you look at where the red arrow there is, and remember who was president from 2016 to 2020.
Mm-hmm.
Right? Well, and what was getting ready to start 2019, see your solid blue line there is your federal funds rate.
Okay.
Trump turned the screws on Powell and got him to lower rates heading late 2019. 2020 is an election year, right? Now this is pre-COVID, guys. Okay, so you got to keep that in mind. Your dotted line there is your inflation rate,
Ooh.
your CPI. So old J Dog there, he capitulates to Trump and drops rates because look where inflation was before that. It was running under 2%. And Trump was leaning on him, hey, cut rates, cut rates, cut rates. Inflation's under 2%. You say your target is 2%, cut rates. And I mean, Trump being Trump, he was publicly getting after Powell to do this. Powell gave in and he cut rates. And look what happened with our green arrow. Look what happened to inflation right away.
Yeah, he won't do that again.
Went above that, right? Went above their 2% target. 2% is their target inflation rate, right? And then COVID hits and all bets are off on all that stuff, right? But so Powell got a little taste of Burns 2.0 there, right?
Now that solid line, Will, is that recession? Is that
no? That is the vertical line. Yes, that's the recession in 2020. Which I think, in fairness, I don't care which side of the aisle you're on here. In fairness to Trump, that was a COVID recession.
Yeah,
that wasn't a Trump recession. Mm-hmm. That wasn't a reset. It was COVID. Mm-hmm. Period. When you shut everything down, it's going to cause a recession. It kind of goes together, right?
It has to. Yeah.
And of course, that brings inflation down because everything's shut down there during the first part of 2020, right? So this is Powell getting a little taste of what it might have been like to be Arthur Burns. And I'm betting he didn't really like that feeling too much.
No.
Okay. So now it's an interesting dichotomy because Powell very publicly changed his stance when this happened. Okay. He had to eat some crow when he gave in to Trump in 2019, 2020. Okay. Well, now look how Powell reacts when Trump says things now. He's very classy about how he does it. I'll give him that. Okay. But he basically says, yeah, pound sand.
Yeah.
I'm not going to be Arthur Burns 2.0. Okay. And so now we can fast forward here, 2022. Thank you. Perfect. No, you're perfect. Go to that. Okay. That's awesome. Okay. So now we're going to talk about how Powell gets his chance to be Volcker 2.0. Okay. And he's only got a year left. May 15th, 2026, his term's up as chairman of the Fed. And I think it's pretty safe to say Trump will not be putting him back up for consideration again.
No.
Okay. So now we know we get inflation, your green arrow going up. We know that goes up big time in 2021, 2022. Powell reacts to that starts reacting to that in March of 22 by raising rates. Your red arrow there, he raises rates. Inflation starts coming down. Now he's Volcker 2.0, right?
Mm-hmm.
But now we can look at this, and yeah, they dropped rates a little bit there in late 24. But we can see the definite Trump's talking point. Hey, inflation's trending down. Let's cut rates. Now, there's something very different this time than, say, under Reagan or Carter or even Clinton. Up until then, is national debt is a lot higher now. And it takes a lot more to service that debt just based on even if you have 1% inflation and 1% interest rates in, I'm making this up, guys. 1% inflation or 1% interest rates in 1980 on that level of debt, which I think was $800 billion national debt, if only, right?
I know.
To $36 trillion, right? Well, the interest rate matters on what it takes to service that debt, whether it's your debt, my debt, the country's debt, doesn't matter, right?
Mm-hmm.
Well, that's why if you look at the federal budget right now, the most expensive thing is Social Security, then Medicare. The fourth thing is the Department of Defense, and third place is interest on the debt. This is why Trump is doing the Doge thing, because they're cutting expenses. Yes, overall in the overall budget, it's not a huge amount of money. Okay, the numbers are staggering to us regular people, but if you look at it as a percentage of the budget, it's really not that much money.
Mm-hmm.
Okay, yes, I'm not a fan of, the one I saw was something in Honduras about marketing their peas. Okay, it's like $30 million. No, get it back here. Okay, that's great, but I think what Doge is really going after is cut our expenses and increase the credit worthiness of the U.S. government, right? And
Mm-hmm.
tariffs bring in more money, right, wrong, or indifferent, they do. Okay. So you've got increased income and slightly decreased spending. That would make a person more creditworthy, right?
True.
Same thing for a country. So that drops interest rates on the open market, not the Fed funds rate. They do their own thing on the short end, 0 to 2 years of time of debt, right? The very long end of the bond market, the 20-year plus, is really tracks with what long-term inflation expectations are. So that's what people think inflation is going to do. The 10-year bond in the middle of that, so to speak, is its own animal. Long-term inflation rates don't control it. The Fed doesn't control it. The 10-year bond is its own animal, does its own thing. During COVID, all that spending was funded very short term, which was, in my opinion, incredibly stupid. We could
Tell
have
me what
locked
you mean
in
when you say, can you define short term?
less than 5 years and less.
Okay, gotcha.
Okay. And thank you. That's good clarification. They could have easily run at whatever percentage,
10, 30 year, whatever.
Well, they could have run 20, 30 year. There was even a push to start issuing 50-year bonds. They could have locked 50-year bonds in at whatever 1%, or at least do a 20-year. But no, they went very short term on this, and hence we're coming up on this wall of maturity in 2025. And that has to be refinanced, right? If we refinance that at this rate, well, then the only thing that makes sense, just like a person who's backed into a corner, right? Where's the cheapest interest rate at? Short term. So what is the Treasury going to be incentivized to do this time around if Trump doesn't get the 10-year interest rate down, at least 10-year? Because it's its own animal, right? He can have some influence on what the 10-year rate does with his actions. He can't influence 20-year plus because that's long-term inflation rates. He can't influence short-term because that's the Fed. Watch what the 10-year bond does. I believe that's what Trump is reacting to now. Okay. And that's why Trump started capitulating some on these tariff talks and his tough talk, because the 10-year bond yield started going up and he had to calm that part of the market.
Yeah.
Okay. So all this to say this, but the 10-year will also react to what the Fed does to some extent. So this is why Trump is jawboning Powell so bad. And other current members of the Federal Reserve Open Market Committee are officially starting to interview for chairman of the Fed this summer. In
Yep.
August, I think they said they're going to start having official interviews. But watch their talks now. They're pre-interviewing with their talks.
Do you
Okay.
know who's in the running, the top 3 to 5 folks?
I know that the one that's seen as the favorite right now is a gentleman, last name's Waller. He is very dovish. He has all but come out and said, Trump, if you give me this job, I'll do whatever you want.
Wow.
Yeah. Which
It's
is somewhat
interesting.
scary. I want
think,
some sort of adversarial relationship there.
yeah, I'm going to look into that, see if I can figure out who the top 3 to 5 folks are. Maybe we can look at what they're currently saying and tweeting and stuff like that.
Yep. And in fairness, Trump is going to appoint whoever's going to do what he wants. Same way Obama did, same way Clinton did, same way Bush did, right? It's just, they're not going to appoint somebody who's going to do the opposite of what they want.
I
And
think
of
it's
course, that'll be
huge for the
fun.
midterms, don't you? You get the new guy in there. Let's say he starts immediately
Mhm.
pulling levers, and it's either going to be great or it's going to be terrible for the
Yep,
midterm.
you're spot on.
Yeah.
Because you got elections in 26, and if the new Fed chairman comes in May, immediately says, making this up, guys, not saying this would happen, I'm going to drop rates to zero, and we're going to start printing money like crazy. Stock market's going to take off, real estate's going to take off, dollar value is going to plummet, so therefore our exports are going to do well, and things are going to look great for the midterms. It may not be the right thing to do long term for the country,
Exactly right.
right? But that's the nature of a 4-year and 2-year election cycle.
Yeah.
All right.
Don Bothwell is on, says, I'm late to
Awesome.
the party, but I made it. Good morning from Northwest Montana, 2270. Tony reminds us the Federal Reserve is neither federal or a reserve. Please discuss.
Absolutely.
And
Yep.
Dr. Gordon Botson is on up there in Ohio.
Awesome.
Good morning.
Good to see you guys. So now Powell's he's in a tough spot here, right? He had his little taste of being Arthur Burns, and now he's got his taste of being Volcker. And, Trump doesn't like Powell. To Powell, I'm guessing that's like, yeah, big whoop, right? Because Powell is worried about his legacy. If he capitulates now and things go badly with inflation, think again about that Michigan survey, what people expect, right?
He can always get a pass for the tough stuff during COVID, but if he screws it up now, the last year, that's all he'll ever be remembered for.
Absolutely right. And nobody's going to remember this bump in inflation before COVID. I mean, that's, that might as well have been 10,000 years ago, right? And it never ran away because COVID caused almost deflation, right?
Yep.
He's going to be always remembered for how he's first transitory, the whole transitory talking point. He's going to be remembered for that, but then be like, yep, then he got it together and he got inflation down. So he's on track to kind of be a Volcker 2.0 here. He's not going to give up in his last year, in my opinion.
Nope.
He's not going to give that up. So he's going to keep rates where they are, and he'll say, World War data driven, and he's going to use all those talking points, and they're all valid, right? But he's not going to risk being Arthur Burns 2.0. And why do I have such a strong conviction on that? I'm glad I pretended you asked, Rich. Powell kept saying things when inflation was high. He'd say, well, the historical record shows that if we lower rates too soon, that is bad. That was a reference to Arthur Burns. Okay. He also kept saying different variations of, we're going to keep at it till the job is done. We will be keeping at it until inflation is under control. And you and I were talking about that exact thing one day on the show. Yep. And I thought, I should read Volcker's book. And Volcker's book title is Keeping at It.
Wow. There you go. I love how subtle these guys are. It's all purposely crafted that way.
Yes, it is. And Powell is one of the best at it. He is really good. Once a person watches enough of his talks and reads between the lines, he puts everything out there. And let's not forget where Powell came from. He's one of the few people working at the Fed that does not have a PhD in economics. He was a private equity guy on Wall Street. Okay. And private equity is privately held companies that accredited individuals or higher, accredited individuals $1 million or better in net worth, or a certain income level, can buy shares in this privately held company, hence private equity. And private equity crushes the stock market. Okay. Private equity averages 15% a year returns. Okay. And that's where Powell came from, was private equity. which is why he typically gives Wall Street what Wall Street wants. So if Wall Street starts talking about, we expect a quarter point drop this year, and 80% of the bond traders think that's the case based on certain metrics, he typically does what they expect. Okay. So he very much works closely with, sorry, my phone's going nuts with alerts on the stock market with everything jumping this morning.
Oh, I bet.
So the Powell is very worried about his legacy. He's got a year to go. I think it's safe to say he knows he's not going to get reappointed for the job. So he has nothing to lose by doing exactly what it takes to make his name go down in history as the guy who solved the post-COVID inflation.
Mm-hmm.
This will temper what he does in the next year. It will also affect me, you, and everybody else. So this is something, and he knows it.
Yeah.
Right. And what's he have to lose? He's an incredibly wealthy man. All he's really got to build now is his legacy.
Mm-hmm.
I mean, if his kids, grandkids, great grandkids don't mess it up, nobody in the future of his family is ever going to have to work. Right.
Yeah.
So he's only got one thing left to work on. That's his legacy.
You know, when you said he's the first Fed chair that doesn't have a PhD, my mind immediately goes to Greenspan. What do you think Greenspan would be doing in this kind of situation?
Oh my gosh.
I mean, is that going to take a show all to itself, or is that a soundbite?
That and probably a crystal ball and a magic 8-ball. You know, the future is uncertain. Well, we can look at what Greenspan did. He basically let the .com bubble run way too long, and he gets credit for popping that bubble, but nobody ever criticizes him for letting it build so badly either.
Yeah.
In fairness. Also, his response to the .com bubble set up the housing bubble because he lowered interest rates and kept them too low for too long, and then conveniently did not seek reappointment just before the housing bubble burst and left that on Ben Bernanke's doorstep.
Yeah.
So, you know, Greenspan was called the maestro because of the way he orchestrated things. If you really want to have a short evening, have a drinking game and go back and watch Greenspan's congressional testimonies. And every time you don't understand what he said, take a shot. You're going to make it about 5 minutes to the point. He was so famous for that at one point, a congressman or senator said, well, sir, I understand what you just said. And he said, well, if you understand what I said, I must have misspoke.
God almighty.
Right. And people would sit there and parse what he said because he was so unclear about it. That's one thing I'll give Powell. Powell comes out and says it. And I'll give him that. Right. We can all respect that. But it was so Greenspan, I don't know. He seemed to run with his own stuff as far as it was very difficult to ever tell what he was going to do. So I really don't know. Don't have a solid opinion on that.
Fair enough.
So
I'm having some technical difficulties. You'll have to advance the slides, Will.
Oh, okay, no problem. So, all right. So, what are the goals of the modern Fed? And by modern, I really mean post, whatever, call it 1970. We'll just throw that number on there. Okay. They want stable prices. What is stable? We would think maybe stable is 0, right? Overall. No, they're stable. Say again, brother.
2-ish%.
Yep, 2-ish% inflation. Now that's odd. Why do we want inflation? If I think of, a 0 rifle and I want that stable, it means I want to stay zeroed for 100 yards, right? Well, no, not in Fed world. We want 2% inflation. So 2% inflation, you could think of that in a very simplistic way as 2% more money in the system every year. That's 2% inflation, right? If you put 2% more currency into a stable economy every year, prices are going to go up by 2%.
Sounds like a hidden tax to me.
Bingo. And that's the way the system is designed to work. That's not a flaw. That's a feature.
Right.
Okay. So,
but in fairness, as I read one time, I don't know if this is true or not, but that means a doubling of prices every 23 years.
So 70, it'd be 36 years. It's a rule of 72. A great way to take your number, take 72 divided by your number 2. The answer to that 36 is how long it takes to double.
Okay, well, there you go.
So if it's 7.2% return in the stock market, you double it every 10 years. So rule 72.
So,
great tool.
so when you hear it that way, if every 36 years the price of eggs doubles, it's like, okay,
Mhm.
well, that's a generation. I can live with that.
Yeah, and it's slow enough. And here's the key: it's slow enough, and it's stable in its path upward, right? And
Correct.
it's predictable.
Yes.
Okay, but this other thing this does is it decreases, or it how do I put this? It decreases the burden of your debts. So if a person goes and takes out $100,000 mortgage and prices go up by 2% a year, well, you have an appreciating asset, right?
Right.
Your pay goes up by 2% a year. So your fixed income mortgage of payment of them, make it easy on myself here, guys, $1,000 a month. Well, if in 36 years, everything else being equal, my pay goes from $50,000 a year to $100,000 a year in 36 years, and let's just say I had a 50-year mortgage, just throw that on there, guys. And my payment is still $1,000 a month. Well, now that payment as a percentage of my income has gone down, right?
Exactly.
That allows me to go buy more things. That keeps an economy growing, right? Because let's
Again,
think about when inflation was running 6, 7% here recently. Was the economy growing like crazy? Yep, it was. And so the stock market was going up too. Assets were going up in value. We're going to touch on all this in the coming shows and how this affects us and how this is going to incentivize us to do certain things. Okay. So inflation is their goal. And if you look at the response to the housing crisis in 2011, I believe it was, might have been 2010, we had 2 quarters of outright deflation. And that terrified the Federal Reserve. Ben Bernanke is the chairman at the time. And they started printing money like it was going out of style. QE1, QE2, they had to get inflation back.
Yep.
They could not risk a Great Depression type spiral.
QE to infinity, I think was an
Yep.
actual comment.
Absolutely. Yep. And that was the final QE, was in
Yep.
QE infinity. And they named it that. That wasn't slang.
Right.
They called it that. Okay. And also full employment is the other part of the goal of the modern Fed. What is full employment? A little bit of a moving target there, as far as I know. Typically speaking, the number I hear is about a 4% unemployment rate. There's always going to be 4% of people that are in between jobs, unemployable, take your pick, right?
Yep.
So that is full employment. And this is something that our psyche changes with, though, right? Because there for a while, I mean, we were running what, 1% unemployment when they were, here, go flip burgers. Here's a $20,000 bonus, right? But there was still some unemployment even during that time. And without getting into the weeds on the different unemployment numbers, there's U1, U2, all the way through U6. That changes over time. We're just going to let that sit for the moment. Their goal is this full employment number. And I think
you raise a great point, because what is employment in a consumer economy? And employment might mean the burger job.
Yeah.
Because we're not manufacturing economy. We're not necessarily a tech economy. We're just a consumption economy.
Yep.
And it's like, so, and then I think a lot of people, and again, I don't want to go too far down this road, but when you see Obamacare, you have to have, if you work X amount of hours, you get full coverage. So then, we don't have anybody here that works as a full-time employee.
Right.
So then you have to get people getting multiple jobs, which again, artificially looks like you have closer to full employment. I mean, there's a whole lot of ways these numbers get played with.
Absolutely. And I believe the number is 36 hours for Obamacare. So a lot of employers just went down to 35-hour weeks.
Yeah.
And then somebody would go out and get a second job, right? Working 10 hours a week.
Yeah.
Well, that counted as a job created.
Correct.
Right. So, but everybody's reacting to their incentives. The employer is acting to their incentive. We can't afford to give people health insurance, and we don't want to deal with Obamacare. So we cut everybody's hours to 35 hours a week. And that person is incentivized to go pick up another job, right? Part-time job, working, say, 10 hours a week. Well, then that rewards the Obama administration with another job created, and their numbers look great.
That's terrible. Yeah. Don says, with 2% inflation our purchasing power would be cut in half in 36 years. Think about how much purchasing power has been lost at the variable higher inflation rates over our adult working lives. Very true.
Very true. And that's the way to look at it. Look at it as purchasing power. It's easy because it's intuitive. How much money did you make last year, Joe? Well, I made this much. Well, what can you buy with it?
Right.
right? Ask the folks in Weimar, Germany, how much they made last year. Didn't matter. Couldn't buy anything with it, right? And that's an extreme example. I'm not saying that's where America's headed, okay? But the extreme example makes it easier to visualize, right?
Right.
So same thing on the flip side of that, think about the Great Depression. Everybody's pay was going down, but you could buy more with it every month. It's
Yeah.
that
But you didn't know what
relationship.
the bottom was either.
Exactly right. And that's
Well,
where that's scary. And then when people get scared, they react by not spending.
correct.
Right. So everybody's reacting to their own incentives. We do it every single day. Okay.
Yes.
Now, this is the part that really just in the last couple of years, I've really started to put together. And that is the acceleration of the interventions. Each intervention does more for longer. And what it does, let's dig into it. I think you'll see what I'm saying. So, .com bubble, basically the Federal Reserve. This is the Federal Reserve interventions. Okay. .com bubble, basically they lowered interest rates. And they may have bailed out a few banks. I really had a hard time finding anything about any bank bailouts for the .com or any corporate bailouts. So I don't think many, if any, happened. So the Federal Reserve lowered the interest rates. That basically benefited the banks. Okay. Because if people needed money for something, they still had to go get that loan for it. Right. And this is going to become important, I think, later on in our talk on this slide. So .com bubble happens, Greenspan lowers rates. The banks benefit from that because people who need money go get a loan. The banks make money, right? 9/11 happens. They lowered rates again. And of course, these two things happen in very close succession. And so the banks benefited again. There was a lot of stimulative spending. They didn't talk about it in stimmy in the sense we think of it in a post-COVID world, but it was stimulative spending from the government to fund the global war on terror. A lot of money came pouring out of the federal government. And this is going back to the innocent days of the $1,200 check that Bush put out to everybody, right? And I was just as critical as you and anybody else when George W. Bush came out and said, if you want to be patriotic, go shopping.
Yeah. Pissed me off.
Yeah, pissed me off too at the time. But you know what? He was right. Because when 70% of the economy is consumer spending, he had to do something to keep the consumer spending during a very uncertain time. It was stimmy in a sense. Okay. And the lending standards were further loosened after 9/11, after .com bubble. And this set the stage for the housing crisis.
Yeah, I want to go back to the Bush thing because I just
Okay.
can't let that go. I mean, when I say piss me off, if you think of like World War II, hey, Boy Scouts, turn in your comic books. So we're going to take that and we're going to turn that into pulp and we're going to use that to build whatever. And we need your wood to build crates. We need your, mom and dad. Let's have a scrap drive to make bombs. And here it was like, no, get a mocha latte. That's how you're going to help your nation and be patriotic. And I remember I was on recruiting duty on the morning of 9/11 and every day thereafter for the next 14 years. And I remember being like, he never once said, go enlist. Never once. Even when all the branches of services were missing mission and we can't keep enough people to go fight in the surge. And it's like, and he still kept banging that drum to go shopping. And I'm like, man, I don't get it. I never will get it.
Well, he was only looking at one side of the equation, right?
Right.
And in fairness, you too.
Yeah.
Right.
Absolutely.
So, and that was your job at the time. And that was, what you were looking at, what you were incentivized by, right? Throughout those different incentives, right?
No, you're right. But I mean, at the same time, I was in the market at the time. You know what I mean? I mean, I've got a foot in both places, but as an American, that's what I think people stop as an American. What is the right thing? And the answer is yes. It's say both. Go buy your latte. And oh, by the way, won't you stop by a military recruiter with that coffee and see what he has to offer you?
Yeah.
It may be nothing, but it might be something. And right now we have the post 9/11 GI Bill, blah, 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 blah. There's a whole lot of things you could have said, but he didn't.
Yeah, you're absolutely right. Yep.
I don't know.
But he was Bush was only looking at one side of the equation from that standpoint. Yeah. I'll agree with that criticism all the
Commander
way.
in chief, though, brother. I mean,
Yep.
let Greenspan do what he's going to do, and you be commander in chief for 15 minutes, will you, please?
15 whole minutes. So, all right. So then this sets the stage for the housing crisis, right? All this loose lending standards. And bear in mind, the Federal Reserve bears some responsibility for those loose lending standards because the Federal Reserve regulates the banks.
Yep.
Right.
Greenspan started that.
Yes, he did. Okay. So the housing crisis shows up. Lowered interest rates to zero. That benefited the banks because they're getting free money. Okay. And this is going to become important when we get down here to pandemic stuff. The banks were told, here's this money at 0% interest. Go forth and do what you do. And the banks looked around and went, there's a lot of risk out there. Yeah. We're not going to lend this money out because we're not sure, even if it's 0% to the bank and they're lending it out at, say, I don't know what mortgage rates were then. I don't remember, say 3%. Well, that's a decent spread when you put that across billions of dollars. But then we're not sure we're going to get repaid because everything's so uncertain. So they went and put the money in the stock market.
Yep.
And then
which is not what they were supposed to do.
Exactly. Only about half of it was lended out. The other half went into the stock market. Okay. So then the Fed's answer to that was, well, if we only got 50% effectiveness out of that money, let's just do more. Well, you get QE1. It starts with that. Then they do QE2, and the banks went, oh, more free money, and the stock market's starting to recover.
I know where that's going to go.
I don't have to write loan paperwork or anything. I just go put in an S&P fund or whatever they decide to do with it, right?
Yep.
We get QE infinity. Then we got Operation Twist, which I'm not going to dig in too much, but that was the Fed refinancing short-term debt into long-term debt to decrease the interest rate. Okay. But all of these things, all the QEs, the primary beneficiary was the banks because they got the spread on it if they loan the money out, and the other half of it, give or take, they put in the stock market and made money for them.
Yeah.
So the banks benefited big time. There were also other things that happened in there, but with the banks, but we won't go too far down that rabbit hole. The most important part is this response to the housing crisis eliminated the pretense of risk for the banks because the Fed was going to come in and backstop them.
Yep.
Right? Moral hazard. Why shouldn't I take that risk? Somebody comes in here and bails me out. It's like the college kid whose daddy always comes in and makes a donation after junior screws up and gives them, pays off the platinum card every month. And that's exactly what happened with the banks. Yep. And let's face it, if I was a banker at the time, I'd have been like, yeah, okay, fine. Right. Yeah, see my new Bentley? Things are awesome.
Well, especially once your bank becomes labeled a GSIB.
Mm-hmm.
Oh, I am?
Yeah.
Oh, well, okay. There is zero moral hazard for me now.
Mm-hmm.
Zero.
Absolutely true. So, so the banks are just reacting to their incentives too and making rational decisions based on the conditions in front of them.
That's right.
So it's easy to sit back and blame them. I do. You do. I think most people do. But, greed takes over.
Mm-hmm.
Right. And if any of these banks are publicly held and they don't do this, well, now they're not taking care of the fiduciary responsibility of their shareholders, right?
Right.
I love
this response, though. I love your thing here, the stimmy checks.
Yep.
If banks aren't going to do it, we'll just helicopter money out to them.
Exactly right. So now pandemic happens, they lower rates to zero. That helps the banks out. But again, it's scary time. So they do some loaning, but not maybe as much. So the Fed and the federal government together went, we're going to do stimmy checks. So now it goes straight to the people. And they cut out the banks because now what are the people going to do when they get the money? They're going to spend it.
Well, you hope they do. But
only about half of it was spent, which oddly enough marries up with the same number for the banks. But
because what was half of it going to?
Debt reduction.
There you go.
Now, here's the thing, though. That benefited the banks too.
Exactly.
Because now the banks don't have that risk sitting out there during an uncertain time. It benefited the person as well because now they're not sitting on this debt. But I will argue that there was a installment plan on the stimmy, so to speak, for the half that went to debt reduction.
Uh-huh.
Credit card balances are back to record highs now, right?
Oh, yes, absolutely.
So essentially,
and don't forget buy now, pay later.
Exactly. So
on
now,
top of that,
but just stay with the stimmy side for a second.
Yeah.
So half goes to spending, half goes to debt reduction, right?
Mhm.
And then over time, the 50% that reduced their debt, they built that debt back up, right?
Yes.
So an argument can be made that it was the second half of that stimmy that went to debt reduction eventually made its way into the economy anyways. People charged their credit cards back up.
Have
You
you
see, you see my logic there?
have you read anything on the efficacy of those stimmy checks?
Just basically what we just talked about.
Yeah,
As
I would
yeah.
love to read. It's like just strategic bombing work, just carpet bombing the country. And I would intuitively say, well, yeah, it does. But if you
Mhm.
look at all the studies, all of them, they say it doesn't work. So I wonder if the Federal Reserve has some sort of publication that's Brookings or somebody has put together that says, here's the overall efficacy of a stimmy so that they know the next time we do it, it's going to have this or that effect. I mean, do you think when and if we do a stimmy again, it's going to be a 50-50 debt reduction by buying a flat screen?
Depends.
Mm.
Do we have a central bank digital currency?
Oh, God.
Because if we do, they can direct how that money's spent or it
That's correct.
expires, right?
Absolutely. Yep.
So I would say that if they did another one right now with where credit card debt is, I would say maybe 50-50. Hard to say an exact number, of course, impossible to say because it depends what else is happening with the economy, right? So, but the lesson here the Federal Reserve learned was you go straight to the people and you get an effect.
Mm-hmm.
And it's a quick effect, right?
Yeah.
And it still benefits the banks. When people pay off that debt, yeah, the banks make less money, but they've also decreased their risk substantially.
Correct.
So there is a benefit there to the bank as well. Okay. So now that brings us around to 2023. Okay. So the Fed's tightening, right? Meaning they're raising interest rates and they're also doing quantitative tightening, which pulls money out of the system. I believe it peaked at $40 billion a month they were pulling out of the system.
Oof.
Okay. Those two things in concert is what brought inflation down. Okay. Quantitative tightening is still happening right now, the best of my memory, but it's down to like 5 billion a month. On the economy of our size, 5 billion a month is not a lot of money. Okay. All right. But the Biden administration, this isn't a political statement, this is math. Okay. The Biden administration didn't like this because they were scared the economy was going to slow down coming into an election. So Congress as well, because the Congress people on both sides of the aisle want to get reelected. And this did go through Congress. This was not executive actions. So it was both sides of the aisle said we need to do more government spending to support the economy. So traditionally ish, we run about our deficit each year runs about 2% of GDP. Okay. Under Biden, according to the news media, we had a thriving economy that required a 6% deficit per year measured in GDP. Why did we need all that in a thriving economy? Because Biden wanted to get reelected / get Harris elected as that situation morphed, right?
Mm-hmm.
So an argument can be made that that's 4% excess deficit, right? Normal's 2% deficit. We went to 6% deficits. Well, the economy was growing at just over 3%. Well, you take out that excess 4%. Do you have negative? Do you have close to zero? Don't know. It's something less than what we got, right? So, but what they also in this figured out is, hey, as long as somebody's willing to buy the bonds, the
Mm-hmm.
U.S. Treasury bonds, we don't need the Federal Reserve to print money. We just issue bonds. As long as somebody buys them, we get that money. So now you've got a fight. You got the Fed tightening, and you got the federal government stimulating.
Mm-hmm.
To my knowledge, that's never happened before. In the past, they've worked in concert. Now you got them fighting each other. Okay, so I don't really expect that to become a big deal because Trump's going to get to appoint the next person starting next May, and he's going to pick somebody who's going to do what he wants, same as any other president would. So I
And short
wouldn't
term,
expect
that'll probably be fantastic. Long
short
term,
term it'll be really good.
Yeah.
I mean, if they start cutting rates, I am buying any asset with both hands,
and they
and
know that.
probably with leverage.
Yep.
Okay. Because if you think back in time, every time the Fed started stimulating, what's the smartest thing you could have done? Buy
Anything.
anything. I mean, look at it since. Here's okay. I'm going to go off on a rant for a moment. Financial planners, okay, drive me freaking crazy.
Yeah.
Okay, they will go in and say, "Well, Mr. Brown, if you look at the model that we use over the last 40 years, it's gone up an average of blah 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 blah. You know, smoke, mirrors, bull crap, right?" Well, you go back 40 years off right now, you get 1985.
Mm.
When money started getting cheaper, 82.
Mm-hmm.
Every asset went up. It didn't matter where you put your money. Some went up more than others, in fairness, but every asset went up because the dollar has been devaluing since 82.
Mm-hmm.
Right? So this is new territory. There's a reason the 1970s almost bankrupted Warren Buffett and a lot of other people.
Mm-hmm.
Because you had a stagnant economy and inflation. It was, you look at the stock market in the 70s, it was nothing. So if you go talk to a financial planner, or anybody's listening to this, when they hand you that line of BS about over the last 40 years, to show me what your model did from 70 to 82.
Mm-hmm.
They won't do it. And what is it? I mean, if we go stagflationary here, which I honestly don't think will happen, but if we do, because the society is not going to put up with stagflation. They're gonna be like, hey, we know we can print checks.
Mm-hmm. Exactly.
Right.
Yeah.
And last time we got inflation from printing checks, we just raised rates for a little while and everything got all better. So do that. Right. Society's not going to put up with.
It don't, brother. It works.
Yep.
Till
Well,
it don't.
and society is not going to put up with stagflation or, a bad recession for any length of time.
No.
I don't see it happening. Okay. So this is the fiscal twist since 23, which we touched on. All the previous, in my research here, and I stand by to be corrected on this, the manipulations before 2023 were all done by the Fed. In 2023, really starting in late 22, the federal government started stimulating the economy through the Inflation Reduction Act, which somehow, when the government spends more money, that's reduces inflation. I haven't figured that one out yet.
Yeah.
Okay. So
it's like Iraqi freedom, actually.
Exactly.
Invasion.
Yeah. Right. So this was contrary to the Fed's efforts to rein in inflation. Okay. Fed was holding rates higher using quantitative tightening to moderate economic growth and therefore inflation. Mm-hmm. Biden administration didn't like that. And in full credit to the Biden administration, they went through Congress and both sides voted for it. Okay. To counter this, they started spending money. Okay. Mm-hmm. How did we fund this? Sold bonds, right? If you go to the next slide, you can see, obviously, so this is the federal debt, okay, as a percentage of GDP. Mm-hmm. And you can see it, let's look at like 2008, jumps way up, mm-hmm. response to the housing crisis, and then it levels off as a percent of GDP. Now, that doesn't mean the federal debt leveled off. That just means the federal debt is going up at about the same rate as the economy is growing. Okay. Obviously, it spikes up in 2020, response to COVID. It comes down, but look at the very right side of that chart. It starts sneaking back up again.
Oh, yeah.
And if you go to the next slide, brother, we zoom in on that. And you can start to see here, first quarter of 2023, it starts going back up again. Mm-hmm. Okay. So this is when the federal government starts in stimulating. Okay. Now, depending on who you read, which school you want to go to, somewhere between 120 and 130, 135% debt to GDP is the tipping point. You never come back from it as a country.
Really?
No country ever has.
Ever. Say that number one more time.
Somewhere in the 120 to 135%.
Okay.
If you look at our chart here, we're at about 121, 122 right now. Mm-hmm. And that's not going down. No. We're going up $2 trillion this year. Okay. Now, bear in mind, this is as a percent of GDP. So if the economy grows enough, this actually goes down, even if the debt actually goes up. Okay. So if we grew our economy enough, you could grow yourself back down to 100%, even with debt going up. Right. So it's not intuitive because it's a percent. Think of it as you can grow your debt every year if your income is rising.
Sure.
right? And if your income goes from 100,000 a year to $200,000 a year, and your debt goes from 100 to 150, your debt to income ratio actually went down. Think about it. The numbers are a little more manageable in my brain that way. Okay.
Yeah.
So if Trump is able to get the economy to grow enough through inflation, right? If he gets somebody like Waller in there next May and they start printing money, inflation takes off, and the economy grows because of that, and the deficit grows slower, this number will come down, even though we go to say 42 trillion in debt. Okay. So this is the big.
I'm watching the stock market over here on the side.
I'm sure it's going nuts.
It is blowing up, bro.
Awesome. Good. Yeah. Making money, baby. Making money. So this is the setup for the MELTUP. Okay. All right. If we go to the next slide, I can't actually remember what's left. Okay. So the next show we're going to do episode 2, the downturn. Will we have another economic downturn at some point, brother?
I think so. Yeah.
Yeah, we have to. We always do, right?
Yeah.
It's the cycle, right?
Right.
So will there be an economic downturn? Yeah, there will be. When? Don't know. Why? Don't know. Don't care.
But will it happen before the midterms is what I'm worried about.
Don't know. And in this context, I don't really care.
Yeah.
In the context of our discussion here with this MELTUP series, can it be stopped? Can we stop the next economic downturn? Yeah, we can.
So. Ow. Printing money?
Print enough money.
Oh, Jesus.
Yep. How do we, let's face it, when we shut the economy down for COVID, and we all know the first 2 years of the 2-week shutdown is the hardest part. Okay. Did we have an economic downturn? Really? Not really. No. Yeah. Statistically, it was a recession. It was 2 quarters of negative GDP growth, right? But did it really feel like a downturn when the checks were showing up every week?
No.
So can a downturn be stopped?
It was not only with the checks showing up, but they stopped the student loan repayment, right?
Yeah. And you could do forbearance on your mortgage and not pay your mortgage. It just got tacked on in the end.
Yep.
So can we stop the next downturn? Yeah.
For a while.
Well, yeah, you're right.
Not forever.
Not forever. Because eventually, if you went far enough, you would get Weimar Germany.
100%.
And I'm not saying that's where we're going, guys. I'm not that guy. Okay. But can you stop the next economic downturn? Yeah. We stopped COVID. We stopped the housing crisis. It took a long time, and there was a recession. There was a lot of pain. But through manipulations from the Federal Reserve, they stopped what many argue, and I would go along with, probably should have been a depression with the housing crisis.
Yeah.
Okay. But they stopped it by printing enough money. And you'll notice every intervention gets bigger, doesn't it?
Oh, it always will.
Right? TARP. Remember TARP?
600 billion or whatever.
$700 billion. Now it's a rounding error now.
Oh, yeah. That's nothing.
Right? But look how everyone gets bigger. Every intervention gets bigger and more intrusive. Before, they would just lower rates and then wait for those lower rates to work their way through the banks and the economy, and it would take months, if not years.
I remember when TARP happened. I remember like it was yesterday. We were sitting in our office in Paris Island, had Fox News running. And I'm like, what number did they say that was again? I was literally like, oh my God.
Yep. It was the end of the world.
$700
billion. What did Bush famously say? I had to abandon free market principles to save the free market.
Jeez.
And he wasn't wrong.
No.
Right? Here's one for you.
This
will get Dr. Fuller day drinking. Interest in the national debt is $4 billion a day.
A day. It just interest. Not paying a dime toward principal.
So you do divide that by 24, you get $166 million an hour. Divide that by 60, you get $2.8 million a minute. Divide that by 60, you get $46,000 a second.
Yeah.
Okay.
And this is where I go back to saying, as an American, as someone that has a grandchild now, as someone that's looking toward the future and the legacy of our country, it's like, man, this is unsustainable.
Okay. So I just did the math. So an hour and 39 minutes into the show, that's $275 million in interest in the national debt.
Just during the time we've been chatting.
Uh-huh.
Wow.
Yep. Other than that, everything's awesome.
Everyone stay calm.
Yes. Remain calm. All is well. So, yep.
Well,
Yep. So this is so something's got to give at some point. Now that said, how do you get that if you go back to that previous slide, brother?
yeah, man.
$4 billion a day, right? I
Yep.
can make that go to zero tomorrow. Well, I can't. J-Dog can.
How does he do it, Will?
Make interest rates zero. How do you get interest rates to zero? Recession. So this problem can go away in a heartbeat, so to speak. I've got a mortgage on my house, 2.75%. I pay X dollars per month in interest. I can go to zero with a 0% interest mortgage. You're not going to like what it takes to get back to 2.75% mortgages. Same way we didn't like the COVID stuff, right?
Yeah.
Same way we didn't like what it took to get from 6% federal funds rates in 2006 down to 0% in 2010, right? But it can happen. And it makes debt manageable if the interest rate's low enough.
True.
It's all the relationship of the numbers, brother.
But at what cost in the long run?
Exactly.
Yeah.
So we're going to get into that in the coming shows, probably 2, maybe 3 more. We're going to talk about this melt up and how that theory goes. And some of it I agree with, some of it I don't with the theory, but I think it's important for people to see, see what's becoming a more commonly held belief out there that this could happen.
Mm-hmm.
And so, and everything in the world influences this. China, tariffs, China, Taiwan, India, Pakistan, all these things affect it. Not so much the Kardashians, for the record.
That's weird, though. You'd think they had no.
You would think so. You really would. But it turns out not.
And that's what I was talking about. Consumer economy. Well, we do export something. We export that garbage around the world and poisoning everywhere it lands. But anyway, I digress. Will
we also, for decades, we've exported U.S. dollars.
Yeah.
If you look at our trade deficits over all the years since we'll pick 94 when China entered the World Trade Organization. That's when it really took off. Look what our national deficit has done in that period of time, and look what our trade deficits have been, and it's pretty close to the same number. We've exported dollars to enrich the entire rest of the world, and your beautiful little granddaughter gets to pay it off. Or pay for it, whether that's monetarily or with pain. And that's what I'm trying to do, and I know you're trying to do here, is let's use some knowledge so that our families are better off.
Mark says, how is Basel 111 going to affect banking going forward?
So Basel III rules, in all candor, I'm not that familiar with them. Okay. I need to get educated on that. So I'm glad you brought it up, Mark. I'm going to make that a priority in the next week, and I'll report back. I do know it required banks, even the GSIBs like JP Morgan, Jamie Dimon went out there and talked down Basel III a lot. It increased the reserve requirements for the banks. Mm-hmm. And the banks don't like that because then they can't loan out as much. They make less money. Mm-hmm. And they're restrained by those rules. But I will look into that. Matter of fact, here, I'm going to use my Palm Pilot and make myself a note. Okay. Because this is going to play into things, because the banks are now required, incentivized to do certain things. That's going to affect all of us. So thank you for bringing that up. So next week we'll continue the MELTUP series, but we're going to kick it off with stuff talking about Basel III. I'm not going to spend a ton of time on it. Maybe I'll have more stuff for you to go look at. I don't want to eat up a bunch of time on this MELTUP series with that, Mark, just so you know. That's right off the top of my head. That's my plan.
Oh, well, thank you so much for all the work you put into today's show, man. Mm-hmm. Really appreciate it. Looking forward to this series. And whenever you're ready, my dear friend, you may take us out, please.
All right, brother. The fight's coming, folks. Be ready.